Most people think the biggest difference between a day trader, a swing trader, and an index investor is skill. It isn't. It's math. Imagine three people start with exactly the same amount of money, $10,000. They all open their laptops on the same Monday morning. 5 years later, one has doubled their money, one barely broke even, and one quietly built more wealth than either of them expected. What's strange is that the person who made the fewest decisions often ends up with the best result. That sounds backwards, because we're taught that working harder should produce better returns. In the market, that's not always true. The stock market has a strange sense of humor. Sometimes doing less is exactly what makes more. Let's meet our three investors. The first is the day trader. Every morning begins with charts, candles, news alerts, economic reports, order flow. A single trade might last 5 minutes or 30 seconds. The goal is simple. Capture tiny price movements over and over again. 1% here, 0.5% there. Do that enough times, and the gain should pile up. At least that's the theory. Now meet the swing trader. They're not interested in every little move. They'll hold positions for days, maybe weeks. They're looking for trends. If a company reports strong earnings or a sector starts gaining momentum, they'll ride the wave until the momentum fades. Fewer trades, less stress, but every position carries overnight risk. Bad news doesn't wait for the market to open. Finally, there's the index investor. No complicated charts. No watching every candle. No chasing hot stocks. They simply buy a fund that owns hundreds of companies and keep adding money over time. It's almost boring, which is exactly why so many people underestimate it. Now here's where the math starts becoming uncomfortable. Suppose our day trader earns an incredible 1% on a winning trade. Sounds fantastic, but they don't keep the entire 1%. Every trade comes with costs. Broker commissions, bid-ask spreads, slippage, taxes, even tiny fees quietly eat away at every transaction. If someone makes 200 trades in a year, those invisible costs aren't tiny anymore. They're enormous. Then comes the harder problem. Losses. A 10% loss requires an 11% gain just to get back where you started. Lose 20%. Now you need 25% just to break even. The deeper the hole gets, the steeper the climb becomes. Markets don't care how hard you're trying. Now look at the swing trader. Fewer trades mean lower costs. That's already an advantage. But timing still matters. Miss the right entry. Hold a little too long. Sell a little too early. Small mistakes compound. Even professional fund managers struggle with this. Year after year, many fail to consistently beat the market they spend their entire careers studying. Which brings us back to the quiet investor. The index investor isn't trying to predict tomorrow. They're buying ownership in businesses. Some companies fail. Others become giants. The index quietly replaces the losers with stronger companies over time. Without doing anything, the portfolio evolves. It's one of the few financial systems that automatically removes weak performers. Imagine owning the entire economy instead of trying to guess tomorrow's winner. Historically, broad stock markets have delivered roughly 10% annual returns before inflation over very long periods. Not every year. Some years are terrible. Some are spectacular. But over decades, compound growth becomes surprisingly powerful. $10,000 growing at 10% annually becomes more than $26,000 after 10 years. Leave it for 20 years. Now it's over $67,000. No perfect trades. No market predictions. Just time. Time quietly does what constant activity often cannot. Here's the irony. The day trader may spend 6 hours a day watching screens. The swing trader checks charts every evening. The index investor might spend 10 minutes a month buying another share. Yet the person making the fewest decisions often captures the largest share of long-term market wealth. Not because they're smarter, because they're making fewer expensive mistakes. That's a lesson human psychology hates. We're wired to believe action creates value. Financial markets often reward patience instead. Of course, none of this means day trading or swing trading can't work. Some traders build remarkable careers. But the odds are different. Professional firms use faster computers, better data, cheaper execution, entire teams of analysts. When individuals enter that arena, they're competing against people whose full-time job is finding tiny advantages measured in milliseconds. It's a race where many don't even realize who they're racing. So the real question isn't which strategy sounds more exciting. It's which game you're actually playing. Are you trying to outsmart millions of other participants every single day? Or are you quietly betting that businesses, innovation, and entire economies will continue growing over the next 20 years? Because in investing, the loudest strategy isn't usually the strongest one. And sometimes the biggest advantage isn't finding the perfect trade. It's understanding which numbers matter before the market teaches you the lesson itself.